Our guest says this trade war does make the risk of stagflation even more possible. And of course, that would be an unpleasant combination of rising prices but weak economic growth. Let's bring in Erica Lau, CEO and lead portfolio manager at North Growth Management. Erica, thank you very much for joining us.
Thank you, Andrew.
Sounds like a horrendous prospect, doesn't it? People losing their jobs, companies may be going out of business, but prices rising at the same time.
Yes, and I think that is what caused the big market sell-off starting less than a week ago, I think, on April 2nd with the announcement of the Liberation Day tariffs. That was when everything changed, and it really introduced a lot more uncertainty for the markets, which hate uncertainty. The announced rates were much worse than what was feared already. It was broader, it was deeper. It brings the effective U.S. tariff rate to 23%, and that's from 2% last year in 2024. It would also be the highest rate in over a century. So there really is no roadmap for the markets, and that is what caused a repricing of risk across all asset classes, really, but especially in stocks.
And critics of President Trump, of course, say this is not based on economic reality. What he really wants is tribute from countries. Now, I know we can't get inside his head, but quite a few economists are just questioning the whole rationale behind these huge duties.
Yes, and there are still a lot of unknowns. We're not sure if this is to maximize leverage on negotiations. There does seem to be room on bringing the rates down. There have been news out of the White House that they are willing to engage in talks. And so that was positive for the markets today until we got news of the additional tariff rates that will be levied on China.
We're going to get some stock ideas from you in a second, Erica, but broadly, have you raised the cash portion of your portfolios?
We have not changed our portfolios. We do think that the most important thing for stock investors to focus on really is the long term. We invest based on individual fundamentals, which takes into account earnings and cash flows and strong balance sheets so that these companies are able to pivot, they're able to emerge stronger when the adversity subsides. And that is what we focus on. And so really the stocks that we've liked, a month ago, 2 months ago, they are the same. We do believe that the best opportunities usually arise during market turmoil, and it's important for investors to know that volatility works both ways, that it works both on the downside and the upside. And it is about time in the market and not timing the market really that matters, because what we have seen is that interrupting compounding really significantly decreases investment outcomes and returns.
Bombardier, you think you like the prospects for that stock. Why is that? What attracts you to that private jet maker?
The private jet maker has had a really good record over the last 5 years of increasing margins. The demand continues to be strong despite the uncertainty for now. And really the aviation industry the supply chains are very intertwined. So similar to the automakers, it is not easy for supply to change overnight. And so really this is a good this is a good aircraft maker, and it has got a good long-term trajectory for growth ahead of it, being able to expand its aftermarket parts business. As there are more jets in the air, the services business will increase margins in the long term.
The Dollarama, a favorite for many investors right now, though we may be looking at harder times ahead. People will be looking for discounts.
Yes, and that does benefit Dollarama in the near term as the consumer is stretched. Dollarama is very well positioned, being a value retailer, a Canadian staple. For many Canadians, they visit Dollarama frequently. 70% of Canadians visit the store once a month. 29% actually visit once a week, and there is still room for Dollarama to increase their store penetration in Canada. Longer term, they have many opportunities outside of the country, in Latin America and in Australia, with their recent acquisition of TRS. And this is a best-in-class retailer. Even when you compare it to its U.S. peers, Dollarama has high operating margins of 25%.
What was the acquisition you mentioned there, Erica? Oh, the
That,
reject shop.
they announced,
Sorry, go ahead.
yes, the reject shop TRS. Yes.
How could I forget that? Yeah, in Australia, the reject shop. Yeah, very typical Australian,
Yes.
that sense of humor. Yeah, sorry, I'd forgotten about that one. Jabil, the electronics contract manufacturer, I think you've told us before you like the look of this one.
We like it because they've done a very good job diversifying their business, so they are not just electronics contract manufacturer, although they do benefit from the build out of data centers and the spending related to AI. That's a really good long-term driver for Jabil. The real story behind Jabil is that they are a very good operator, that they've been able to increase their margins and diversify their businesses into higher margin sectors. And they really manufacture everything, and they've got a worldwide footprint. So we do believe that in the long term, they will benefit.
Thank you very much. It was great hearing from you as ever.